Hello and welcome to another video on how to secure yourself financially, and specifically looking at the beginner guide to financial statement. And in today's video, I'm going to make a quick recap about this website, right? So the SEC, the Security Exchange, the U.S. Uh, Security and Exchange Commission, okay, the SEC. So they create this uh, content to mention that if you're able to read nutrition label or read baseball box score, you can learn to read the basic part of financial statement. Or if you can follow a recipe or apply for a loan, you can learn the basic of accounting. And the basic aren't difficult, they aren't rocket science. So these sections illustrate that how by you gaining understanding on how to read this basic part of financial statement, much like CPR course teach you how to perform basic cardiopulmonary resuscitation, but it won't train you to be a cardiac doctor. So in this section, it won't train you to be an accountant. However, it can give you some confidence. So when you're able to see a set of financial statement, you can make sense of them. And that's the whole point of this section. So first, describe what is a financial statement. So after all, they show you the money, period. And you have four type of financial statement: balance sheet that show what a company owns and what a company owns and what it owes at a fixed point in time. The income statement show what a company uh, or how much money a company made and spend to produce the good and service over a period of time. The cash flow that show is the exchange of money between the company and the outside world, as well as the statement of the shareholders that show change change in interest over time. So with all of this four topics that I mentioned, right? This section only focuses on the first three. And in today's video, I'm going to make a quick recap of these three uh, type of financial statement, as well as additional information or additional concept needed to understand this financial statement. All right. So first, balance sheet. The TLDR of that is, after all, it is a snapshot of the company assets, liabilities, and shareholders' equity in a period of time. So assets are anything that a company owns that has value, whether it's tangible or intangible, as well as you have liabilities, which are obligations that a company have to pay uh, to their vendors, providers, or customers. And the shareholders' equity, which show is the capital or the net worth. So if a company hypothetically decide to sell all of their assets and pay off all of its liabilities, the leftover money belongs to the shareholders. Okay? And this is something important to understand because especially when you are working for someone, right? You don't own anything. So what you're doing is just to collaborate with that person over a fixed period of time. Let's say 9 to 5 or in any relationship. The whole point is that you're helping to other make money in the process. So the shareholders' equity here, okay, which is something that I mentioned, that I described. It also, the balance sheet follow a particular formula called assets are equal to the liabilities, plus the shareholders' equity, right? And most of the time you find this uh, uh, balance sheets organized in that fashion or with all of the assets listed at the top, followed by the liabilities and the shareholders' equity. So, in the asset we generally have is the uh, so all assets are listed generally based on how quickly they can be converted into cash. So you have current assets, which are assets that a company expects to transform them into cash within a year. So, for example, inventory. Uh, Non-current assets, which are assets that a company expects to convert them, that will take longer than a year to convert into cash, and fixed assets, which are assets that are not for sale because it helps your business to run. So, for example, like equipment, machinery, property, the liabilities generally listed based on their due dates, such as current liabilities, so obligations that a company has to pay within a year or less, or long-term liabilities, which are obligations that will take longer than a 1 year to to pay, as well as the shareholders' equity, where here it show is the amount, okay, is the amount owners invest in the company's stocks plus or minus the company's earnings or losses since its inception. Okay, but after all is how much money or the amount of money that the owner of this company as well as the shareholders has invested in the company's stocks plus or minus earning or losses. Okay, earning or losses since inception. And sometimes companies distribute earnings and instead of retaining them. So these distributions are called dividends. So a balance sheet shows a snapshot of a company assets, liabilities, and shareholders' equity. All right. At the end of the reporting period. But after all, the TLDR of the balance sheet is that it's a snapshot of the company assets, liabilities, and shareholders' equity over a period of time. The second type of financial statement is the income statement. So you can think of this as a set of stairs, right? That uh, you start with the total amount of revenue at the top, and once you go down each step down the stair, you make a deduction associated with that cost. And the bottom line of this, or the bottom of the stair, show you is the if a company made profit or not. Okay, the bottom line of that statement shows shows you that show the company net earning or loss. So broadly speaking, you start with the total amount of revenue, and then you deduct things like merchandise returns and refunds to reach to the net uh, income or to reach to the net revenue, uh, and then you deduct things like the cost of sales to reach to among other sales or among other expenses to reach to the gross profit. And when you talk about cost of sale is how much money a company uh, costs to produce the good or service they are providing in a period of time. So the gross profit, right, is the amount of money that you're going to deduct here. Things like amortization and depreciation, uh, as well as the operating expense. Meaning is What are the expenses that a company incur in its day-to-day activities? So, so for example, marketing or research and development, administering salaries, that kind of thing. So once you deduct that, you reach to the operating profit before interest and income tax. So this is something, especially when I look at the interest here, the operating interest, which is the amount of money that you deduct or append to the balance based on money that you lend or loans that you took. All right. For example, money market funds or any activity that generate interest that you have to pay for or that you receive from. And once you deduct all of that, then you reach to the uh, uh, income statement. Do you reach? Then you reach to the net income, right? I mean, sorry. Once you reach that, so once you deduct the interest from the operating profit, then you reach to the operating profits before income taxes. And income taxes is, well, taxes that a company owns to the government. And if that company is a multinational company, well, and now you have to pay income taxes in different jurisdictions. So the bottom line of that show you the net income, all right, of that company. It's all right. And then I look at the cash flow statement. That is also called earning per share, which is a metric or a calculation that is used for tell how much money a shareholder will receive if hypothetically a company decides to distribute all of its earnings, which is something that it won't happen, but it's just a calculation that it used to take the total net income and divide by the number of outstanding share of the company. So this is just a metric that they use. EPS, earning per share, right? And then I look at the cash flow statement, which report is a company inflow or outflow of cash. Both. It reports the company inflow and outflow of cash. And this is very important because company need to have cash on hand, much like a person to purchase assets or pay expense. So give me a second here, please. All right. So, so that's cash flow statement, right? And this cash flow use the information from the balance sheets and the income statement, and the bottom line of that show you the net increase or decrease in cash. Something that I recently taken into account by using Soho Books as this company or this accounting online software created on or headquarters in India. That yes, it will help me to manage much more better my business. All right. So the cash flow statements review the cash flow from one of these activities. So you have is uh, operating activities, investing activities, and financing activities. So operating activities in that section, what it does is to analyze the net income from the income statement and conciliate with the total amount of cash that was used or perceived from other operating activities or from operating activities such as uh, operating assets and operating liabilities, right? So most common operating assets we find here like uh, accounts receivables, inventory, prepay expense. So expense that a company, or in this case, is expense that a company incur for goods and service that will be received in the future, such as premium insurance, home, health, uh, car, vehicle, life, liabilities, disabilities, long-term care, such as nurse healthcare or home healthcare, as well as intangible assets, such as patents, which are mhm, yeah, such as patent, which are exclusive rights to creators. Okay, uh, so yeah, mhm. So which are exclusive rights to creators uh, or inventors to manufacture and distribute their invention over a period of time. So most notable patents are like the GPS, the Global Positioning System, uh, registered in 1973, as their patent name suggests, or as the patent name called, is this navigation system using passive ranging techniques. Another is the maglev, uh, which are it was issued in 1969. This electromagnetic suspension and stabilization system for ground vehicles. Also, the CRIS gene editing tool, issued in 2014, as well as the mobile phone issued in 2007, or for example, the iPhone. Also, the 3GPP, which is this 3G partnership programs, that is an umbrella term for a couple of organizations in manufacturing to follow to create and maintain telecommunication protocols, right? So you have, for example, here GSM, like the 2G, for example, GSM, or this global GMS, this global mobile system, and it is related to G, or two generation. The UTMS, this universal mobile telecommunication system, which are, and it is related to 3G, as well as the LTE, or long-term evolution, and it is related 4G generations and the 5G. So this is just to describe at least some couple patterns that, according to popular mechanics, that change the world. Okay, keep looking at other common operating assets. I find like investment in affiliates, which are investment in affiliates, all right, such as joint ventures, which is a partnership between two or more companies to undertake a specific business activity. Okay, where to undertake a specific business activities, where each part receive a share of the joint venture. So, for example, Croc and Post Malone. Uh, Equity investment. So, where now take a company invests in another company by purchasing this huge amount of shares, gaining significant influence but not total control over the another company management decision. So these equity investments here we have is the Berkshire Hathaway, for example, led by Warren Buffett, which are a holding company that invests primarily in different industries such as energy, healthcare, retail. Also, Alphabet, which is this Google parent company, which is the Google parent company that invests in technology companies, primarily in technology companies, through its venture capital or through its venture capital arm called Google Ventures. Okay, uh, and also, no, associates where now this is when a company uh, owns 50% of a particularly company stocks, limited liabilities, uh, as well as yeah, this is just to mention at least four type of investment in affiliates. So joint ventures, equity investment, limited partnerships, or associates. Okay, as well as the another common operating asset is cash and cash equivalents, such as money market funds, which are useful when you want to park huge amount of money momentaneously. Okay, and in these money market funds, for example, here money market funds, according to Investopedia, right? So yeah, so these money market funds, after all, these are markets which involve is the purchase or sale of large volume of very short-term debt, such as uh, bank acceptance, or in other words, is short-term debt guaranteed by commercial banks, or short-term debt by commercial bank, certificate of deposit, which now are bank issued savings certificate with short-term maturity, repo, this repurchase agreement, which are short-term government securities, the U.S. Treasury, which are U.S. or short-term government debt, as well as the certificate of deposits or commercial paper here, which are unsecured short-term debt. Again, money market funds. The whole or one of the whole point of this, or one of the most common use case, is that it allows you to park huge amount of money for a certain period of time until you decide where to invest. Okay, money market funds, and these money market funds, after all, they are place where funds purchase, or where it involved the purchase or sale of the large volume of very short-term debt. You know, it involved the purchase of exactly. It involved the purchase and sale of large volume of very short-term debt products, and this is something important to understand from this money market. After all, they are debt instruments. that they are buying or selling. Okay, so the money market funds, is the buying of sales. It involves the buying or and sales of large volume of very short-term debt products. What type of product can be? Well, we have here is bank acceptance, which are short-term debt issued by banks, certificate of deposits, which are bank or savings certificate issued by bank with short-term maturity, commercial papers, which are unsecure, risky corporate debt, repo, repurchase agreement, short-term government securities, as well as the U.S. Treasury, or the short-term, which are short-term government debts. So, okay, all right. So, this is just to describe the most common operating activities. And when I look at the most common operating liabilities, we have things like accounts payable, which are money that you owe to your suppliers or vendors, for example, accrue expense, which are involved money, uh, uh, which are expense that a company incur for its day-to-day activities. Okay, whether is income taxes, salaries, utility bills, uh, payments to vendors and creditors, rent. Also, the deferred revenue, which are obligations that a company has to provide for good and service in the future. Subscription models is one example of that. Gift cards is another example. Uh, as well as the short-term borrowing, which are which can be from banks or uh, companies such as private equity, uh, venture capitalists, or you can issue is based on your outstanding invoice. Okay, uh, trade credit. This is when you want to renegotiate with your vendors and suppliers, and also the payroll advance. So money that you give in advance to your employees for that will be deducted in the next payday. Okay, cool. So with that, I also look at the income taxes, which is another common operating liabilities. So income taxes can be corporate taxes, that is very depending on their geographical locations, country legislation, as well as the withholding taxes, which are money that a company deduct from the gross wage salaries and then pays back directly to the government. This is to promote the pay as you earn tax system and to fight tax evasion. If you're not in this kind of relationship, you should go for to fill a form for example, investors or sole contractors. Okay, so instead of withholding taxes, withholding tax, right? Withholding taxes. So, for example, if you're not an employee, you are a sole contractor, or, for example, or an investor. Okay. Um, so they need to now estimate. They are required to pay quarterly estimate taxes. on the US, right? So investors and independent contractors are exempt from withholding taxes, but from not income taxes. Okay? So after all, you're going to be deducted based on how much money you made there. And they're required to pay quarterly estimate taxes. Again, based on your income taxes. And that's one of the things that a lot of people out there try to minimize their personal expense or their income as much as possible and keep their entire income on their business. Okay, so if this class of taxpayer fall behind, they can become liable to back out withholding, which is a higher rate of tax withholding set at 24%. But in any case, withholding taxes is a type of income statement, but that is charged to uh, employees. If you have employees, if your company has employees, you have to use these withholding taxes, okay, which are money that is deducted from the gross wage salary and pays back to the government. Uh, Again, this is a way to promote tax evasion and pay as you earn tax system. If you're not, well, you need to fill a form to pay income taxes quarterly. Pay an estimate to pay quarterly estimate taxes. All right. So this is withholding taxes as well as the sale tax, which is another part of the income taxes. So in income taxes you have is sale taxes, first corporate taxes, withholding taxes, as well as sale taxes. So for example, you have local or state, city, federal, international sale taxes, VAT, the value added tax, which is a tax imposed at every stage of the production and distribution of good and service, where the customer ultimately pay the full VAT for that, and business along the supply chains remit that portion to the tax, right? So after all, ultimately the customer is end up paying the huge amount of cost uh, for for Jesus. It end up paying a huge cost due to their inability or their lack of perspective. But in any case, okay. As well as looking at other common operating liabilities, okay, I already mentioned accounts payable, accrue expense, deferred revenue, income taxes, short-term borrowing, as well as notes payable, which is an agreement between the borrower and the lender, where the borrower outline all the terms and conditions of that loan. So, for example, you have things like banks. So they create these notes payable, or in Spanish, these pagarés, right? Where in there it outlines things like the principal, which is the original amount that was borrowed, the principal, interest, as well as the repayment schedule, and so on and so forth, and other details, right? So banks do that. Companies also generate these notes payable, which after all are debt. Their issue is debt. Uh, or the issue is this borrowing specifically. So companies such as sorry, private equity or any other financial institution, venture capitals, they generate is these notes payable. Governments also rely on that. by issuing government bonds, for example, as well as companies. Again, they also issue is corporate debt or commercial papers, trades, payables. When you want now to renegotiate with your providers and vendors for supplies and raw materials, uh, as well as the um, mm, 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 yes. So as well as the um, mm, 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 I was talking about is the notes payable. So I already mentioned that banks, companies, uh, governments, as well as uh, uh, trades, uh, payables, and the individual or individual notes payable. So when you now wants to raise funds or you ask loan for individuals or on any other companies, and then I look warranties, okay, which is another common operating liabilities. It's the obligation that a company has to provide uh, warranty, or in other words, to fix and replace a defective product. Uh, yeah, warranties to fix and replace a defective product. That's right. Yeah. So with warranty is the obligations that a company has to provide. Is the obligation is Yeah, it's the obligation that a company have to fix or replace a defective product or service, and mhm. So for example, we have things like software warranty, manufacturing warranties, parts, vehicles, uh, software warranties. So with that huge description about the most common operating assets and liabilities, okay, and how the first part of the cash flow statement here, what it does is to look at the net income from the income statement and conciliate with the total amount of cash that was used or perceived from operating activities, operating assets and operating liabilities. So the way it do that is by looking by adjust the net income for any non-cash items, and this is items that affect the income statement, such as depreciation, amortizations, or stock-based compensation. Okay, as well as uh, adjust the net or the total amount of cash that was perceived or used by other operating assets and liabilities. So, all right. So the second part is now investing activities, which generally involve is in the purchase and sales of long-term assets, such as intangible assets, things that I already described, like patents, copyright, trademark, trade secrets, uh, customer relationships, as well as property, plant, and equipment, investment, leasehold improvement, and the invest in the financing activity. These sections, according to Investopedia, Generally look at how a company, or generally look how often a company is raising funds and where the source of that money came from, because that section is what the company is describing on how the that section describes how a company is raising funds from investors and creditors and then pays back directly to capital markets. Okay, or and then pays them back through capital markets. So even though, right, even though uh, okay, even though, right, even though that I look at the financing activity and how this section is used by investors to see if a company is constantly raising funds from debt or issuing. So, from if a company is constantly relying on taking out of debt or issuing uh, bonds, that might not be a good sign of an investment. However, if the cash flow comes from it is operating activities, that might be a good sign of an investment. Again, yes, a company may have good investment, or a company uh, may receive the vast majority of its cash flow from its operating activities, right? However, there is a consequence of that. So what is at stake when you are generating huge amount of cash flow from your operating activities, which after all, the capitalist aspect of business aligns to, but there is a impact in all other aspects of your business or in your surroundings. So, anyways, that's one of the reasons why a particular billionaire mentioned that business is some form of so business is some art form. Because of that, you need to find is a very right balance. All right. Then I look at the read the footnote, which are packed with essential information or information that is relevant, such as accounting policy and practice, or how these companies are adhering to accounting practices and how they are disclosing sensitive data. Okay, an accounting practice such as the GAAP, the generally accepted accounting principle, or the international reporting financial standard. I think it's that. So international reporting financial statement, in international financial reporting standard. Okay. Also, the income taxes, which is now described more in a more detailed way about the local, state, federal, and foreign taxes, pension and post-retirement programs. So, in this section, discuss about the cause of this program as well as how over or underfunded are this program, and the stock options, which is a financial instrument that allows the owner the right but not the obligation to buy a particular asset at a given upon price and date, right? So you have two type of stock options, puts and calls, where now puts are bets that the stock will fall and calls bets that the stock will rise. So this stock options it comes from something called the equity derivatives, right? Where the underlying value of that stocks, or where the underlying stock value at this when the underlying value of a particular stocks are based on an asset, a group of assets, or a benchmark. Okay, so this is just to mention about the read the footnote and how important is that, especially for things that I already mentioned, right? Significant accounting policy and practice, income statement, uh, pension and post-retirement programs, as well as stock options. Okay, and when it comes to now look another particularly financial statement, such as the MD&A, which is the management discussion and analysis for financial condition and results of operations. This section provides from the management audit to investors an opportunity of important trends that has shaped the company past or will likely shape the company's future. So things like macroeconomic trends, or as well as jurisdiction law that might change how this company is affected by the income, by the taxes imposed from particularly jurisdiction or countries, as well as other factors. So this is something helpful to provide more context about the uh, financial condition of the financial health of a company. So now, finally, we reach to what we care about here. Okay, and that is financial statement ratios and calculations. So over the couple videos, I looked at there are several ratios and calculations that I'm not aware of, but I hear or I saw them, and after all, these are metrics or calculations, ratios that are used by investors to evaluate a company. And this ratio or a desire or desirable ratios vary by industry. So first we have the first is debt to equity. This is not in no particular order. Debt to equity ratio of 2 to 1. So debt to equity, okay. Uh, debt to equity is a ratio that is used to decide, or it's a ratio that is used especially on corporate finance, how much a company is leveraging or financing its operations with debt rather than with its own resource. And again, a desirable ratio vary by industry. So this ratio is something important to understand. Okay, debt to equity, right? So if a DE ratio is 2 to 1, it means that the company is taking $2. Uh, that the company is taking $2 for every $2 of debt for every $1 shareholder invest. Again, debt to equity It's something useful, especially for companies and for companies that wants to seize uh, death opportunities to growth. So that if a company is seeking for if a company is seeking for death instruments, or if a company is looking for uh, death instruments to, or yeah, if a company is looking for, if a company is looking for, if a company is looking to expand in its operations, uh, financing that with that up to certainly ratio can be beneficial. Okay, because if a company has a very low debt to equity, it means that it's losing that uh, financial instruments to growth. Again, but the balance here, uh, again, balance here is the key. So this is debt to equity. And with that, that'll be all for this video. Take care. Bye bye.